Welcome to the WTR Small-Cap Spotlight podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. In today's podcast episode, I'm being joined by Bruce Fleming, CEO of Montana Renewables. The company is an unrestricted subsidiary of Calumet NASDAQ, ticker symbol CLMT. Montana Renewables is the first large-scale sustainable aviation fuel or SAF producer in the U.S., with SAF capacity having started at approximately 30 million gallons per year in 2023. The company's low-cost expansion is expected to raise SAF capacity to 120 to 150 million gallons per year by Q2 of 2026 and up to 300 million gallons by 2028, thereby becoming one of the largest SAF producers globally. Also joining me is my equity research colleague, Peter Gastreich. Good morning, gentlemen, and thank you for joining today's podcast.
Morning, Tim. Thank you.
Morning, Tim.
Bruce, for those listeners who may not be familiar with Montana Renewables, would you please provide our podcast audience with an overview of the company and its corporate strategy, and perhaps even provide a quick flyby of your professional background that brought you to the company?
You bet. Thank you, Tim. So Montana Renewables is a U.S.-based renewable feedstock conversion unit. We think of ourselves as the largest agricultural investment in Montana. And, we take various renewable feedstocks. That includes things like used cooking oil, tallow, grease, corn oil, which is a waste byproduct of ethanol production, and then straight up vegetable oils. We convert all of that to sustainable aviation fuel, renewable diesel, a little bit of renewable naphtha, which is a very interesting, green petrochemical feedstock. And we make renewable hydrogen in a novel way. So basically, it's like a mini refinery, except it's a renewable input instead of a crude input. That's a natural extension for me because next year I will hit the 50-year mark in the downstream energy industry. Done a lot of different things in that space for a couple of principal companies. Amoco Oil trained me. That's part of BP now. I was head of M&A for Tesoro. That's part of Marathon now. So, the energy transition is not just molecules and cleanliness. It's these corporate combinations and recombinations and evolution for shareholder value. And against that backdrop, Montana Renewables was another of many small partnered initiatives that Calumet launches. We're a natural small business partnering vehicle. We were formed as a partnership before we converted to a C Corp. And Warburg Pincus is our partner in this particular one. So Montana Renewables, unrestricted subsidiary, aka private joint venture, is us and Warburg. And we're pretty happy with our position on the competitive landscape.
That's great. I have a soft spot in my heart, as Peter knows, for Marathon Petroleum, as my father spent 3 decades in the world headquarters, and then my oldest brother ran their Tampa terminal. So with that, I will turn it over to Peter to ask a few questions.
Great. Thanks, Tim. So Bruce, we'll dive into your operations and strategy at Montana Renewables in a moment. But first, I'd love to hear your perspective on sustainable aviation fuel. What do investors need to understand about the long-term demand outlook for SAF? What kind of market opportunity are we looking at here?
Yeah, so that's a great question. It's on everybody's mind, and I'll give you 3 quick strokes. Stroke the first. I don't read a SAF forecast that's more than about 30 months out. They're interesting to contemplate, but the environment is changing very, very fast. Regulators are changing their approach. Corporations are changing their strategies. Producers are looking for, sustainable advantages so that they can hang in there against a dynamic, evolving industry backdrop. So that's a lot to take in. Stroke 2, an awful lot of thought has been expended on what the sustainable aviation fuel world will look like in 2050. That is an awfully long way to project an awfully long list of assumptions. So, appreciate the fact that the industry has settled on the concept that they don't really have a lot of great solutions to decarbonize other than the fuel itself. That's where we come in. And so providing a renewable liquid transportation fuel to the airline industry is pretty much job one. Now that opens up stroke three. There's a huge amount of experimentation underway. It's technical experimentation, different physical solutions. It's feedstocks, different ones with different properties. It is harmonizing, which has not happened yet, harmonizing regulatory regimes in different parts of the world so that people have one requirement, one standard. So there's so much going on there that, this is a space that's much more suitable for traders, for early round, venture capitalist thinking than it is for long-term mature industry discounted cash flow model thinking.
In your remarks, you touched on the producers and the regulatory environment. I'd be curious what your thoughts are about the prospects for SAF projects if we take into consideration the current policy environment in U.S. and also internationally. Like, are these policies, are we supportive of new projects or not?
Yeah, so that's bifurcated, and I'll give you both views of that. Let's start with last year. So in 2024, world demand was all voluntary. And I think the number that's generally accepted now is that the world had 388 million gallons of SAF. That's not very much. That's doubled this year. So if you snap your fingers and say demand just doubled, everybody should wake up and say, let's talk about growth. Let's talk about supply demand. So let's talk about that. The voluntary market was all of last year's demand. The doubling was the addition of a mandatory volume in the EU plus UK. Right now that is underserved. So the stage is set for a really classical squeeze later this year. If there's not enough volume and people aren't meeting their mandated targets in the EU, what happens to price? And rather than directly answer that question, I will tell you volatility is what happens to price. There's going to be a lot of gyrations. There's going to be some distortions of behavior. Regulators are going to realize they didn't quite get what they wanted, and they're going to possibly tinker. I'll give you a domestic example. The Biden IRA legislation said we want to have 10% of the U.S. pool be sustainable by the year 2030. And here's an incentive, and that was called the producer's tax credit. But it went on to say, don't use any vegetable oil. And it took the state of Illinois, I think, about 3 weeks to trump that and say vegetable oil will be just fine for SAF in Illinois, thank you. And why would they do that? Because the soy growers are important. And the soy growers are kind of centered in the upper Mississippi drainage, upper Midwest. And Minnesota followed that lead pretty quickly. So when you get an unintended response, either the industry is going to change, or the prices are going to change, or the regulators are going to change. That's why this is so dynamic. It's volatile, and what would otherwise pass for a business cycle is compressed into months, not years. So we feel like the winners are going to be anybody who is positioned to be pretty resilient against all of those external forces. Sometimes I say this is like the tides in the Bay of Fundy. And if you look that up, you'll find out that's a high-low tidal range of something like 55 feet. It is just stunning. And you have to survive that. You have to float on top of that. So we feel like we're super well positioned. It's a total accident. The fossil refinery that we converted was in the perfect place for the carbon preference markets in North America. What that let us do was last year be the largest SAF producer in the Western Hemisphere. I haven't got tired of saying that yet. But, for those watching on the podcast, that's about this much SAF. It's a fingernail scrape of the addressable market. So we're super excited. We've got a great position on the supply stack. We're cash flow positive this year. We're reporting positive numbers. Not everybody in our space is able to do that. And so we think that's kind of confirming of our thesis that we're the low-cost provider. That opens a lot of doors. Back to you, Peter. Okay,
thanks for that, Bruce. So, at the North America SAF conference last week, there were a couple consultants talking about, shortages emerging after 2030. But it sounds like, if I read that correctly with your remarks there, that squeeze could come potentially earlier.
Yeah, look, the shortages now, the European mandates are all underrunning. Tell me how that plays out. and I'll lead you a little bit. The easy button is we've got a couple of capable U.S. Gulf Coast producers that can load a foreign flag tanker and get a physical SAF delivery into Europe pretty readily. So there's an ability to close those markets, but now you've done it at a higher delivered logistics cost. So we see a little bit of a short here towards the end of the year. We see a little bit of upward pressure on pricing, and the market watchers are starting to report that already. That's trending in Europe. That's the mandatory result. In terms of the voluntary market in North America, nobody really knows how deep that is. It's always been supply short. All of the available supply was all taken up in the voluntary market last year. If there'd been more supply, we expect that would have been taken up. We see pretty good pricing. We talk commercially about this. We don't want to pin the number, but we're guiding investors to understand that we get $1 to $2 a gallon premium above the renewable diesel. I'm going to go over that slowly. The SAF can stay in the renewable diesel. If there's not a premium, nobody's going to pull it out, segregate it, and sell it onwards. So there has to be a premium or there's no SAF. We see the premium strong, which is an indicator of short. So we're very, very comfortable with market structure. Nobody should be comfortable with market stability. Huge dynamics, regulatory reset, challenge and response.
Okay, so the largest and also the first to reach commercial scale production for SAF in the U.S. So what was it like reflecting back that allowed your team to spot this opportunity and kind of get so far ahead of the competition?
Yeah, luck, to be blunt, but we did it intentionally. The fact that we had a platform in Great Falls, Montana, which basically had the perfect hardware to switch from a fossil service to a renewable feedstock service without a huge amount of capitalization or effort. It was the right unit, the right chemical engineering toys with the right capabilities, and that included additional fractionation that's not commonly available in a fossil refinery that let us pull the SAF out. So we just did it. We just said we're going to do that. We'll find out how the market works. We'll test the depth of the voluntary market. And that's all worked out great.
Okay, that's great. So, thinking about these supply and demand dynamics mentioned earlier, this looks like it's going to pan out very nicely, for your company in the coming years. But switching gears a little bit here, can you share more about your process technology and feedstock? What sets your approach apart from others, and what would you consider to be your key competitive advantages?
Sure. So there's probably three things, and I'll take kind of an investor or underwriter's view of the world here. So where's the risk? What has to go right for this to succeed? Technology is a choice. There are technologies that are alternatives, and people talk a lot about things like power to liquids or municipal solid waste or gasification, Fischer-Tropsch. None of those are proven at commercial scale, and they all cost a lot more capital to set up. So basically, we picked the low capital solution out of the available technologies, and we picked the one that was commercially demonstrated. Today, there are 6 technology vendors that can help you stand up a plant like ours. So we're comfortable there. There's a lot you have to get right to run what is, at the end of the day, a high-risk technical manufacturing business. We handle flammable materials. We handle it at pressure. We handle it at high temperatures. Catalysis requires care and feeding and an expert workforce. You have to know how to maintain and inspect and comply. There's a lot to get right. We had all of that available to us as transferable skills as a petroleum refiner. The only thing we changed was we put in renewable feedstock where we used to have fossil feedstock. And that one small change gave us quite the learning curve and a bit of teething problems. Took us kind of notionally about a year to shake it down, 9 months anyway. I can only imagine what it looks like to underwriters when somebody says, I've got a great business plan, I'm going to build it on this greenfield site, and I'm going to learn how to do all of those things, which my company doesn't presently administer. that's a lot to ask, which is why at the end of the day, we have seen effectively zero greenfield startups come into this space and succeed. That is a high bar. So if you go back and you say, where is the supply coming from? It's coming from former fossil refiners who took idle refinery assets, switched them to renewable feedstock, and otherwise brought all of the organizational capabilities necessary. And every one of these competitors, my peers in this space, struggled with their commissioning also. So, you know, it's just daunting if you don't arguably have a lot of organizational strengths and capabilities. If you do, it's still a hurdle to get funded, because the second barrier is, but it's a government regulated market price. Yes, it is. But it's regulated by a tapestry of things. We feel like policy support is collectively good. It's just not fully coherent. So you've got state and provincial LCFS regulations. You've got a Canadian federal standard and a US federal standard, which on our side of the border is called the Renewable Fuel Standard, aka RINS. You've got historical support for agriculture. That used to be a blender's tax credit, now a producer's tax credit that comes out of the federal budget. You've got state-specific initiatives. I mentioned Illinois and Minnesota earlier. There is a lot going on there. We decided, and it might be contrarian, but we decided when we set this up in 2021 that we were not actually at risk of stroke of the pen upending this regulatory tapestry. There's too much of it. And the trend towards an energy transition continues. Voters want that. They elect politicians that find ways to support that, and it continues. It just doesn't continue smoothly. And so I'm back to dynamics and volatility, and you better be some combination of well-positioned on the supply stack, which we are, well-positioned geographically when the preferred territory moves. We were sending all of our SAF west when Illinois and Minnesota brought their rule. We turned some of that around and we sent it east. Those are very practical disruptions to trade flows. And so, we think we had a lot that was serendipitous that went in our favor. So we've touched on the regulatory barriers. We've touched on the corporate capabilities and existing, qualifications barriers, and we've touched on underwriting. A large player can decide as a corporate strategy to fund this. Everybody else needs support from the capital markets. And frankly, there's been very, very little. Been a lot of talk, been very, very little transactional support. We benefited from the Department of the Treasury deciding to make us a direct loan. Now, that was co-signed by the Department of Energy. It's a loan. They're going to want that money back. But we were one of the very few to get through a gauntlet. And that gauntlet included 3 years of due diligence work. A lot of very strong players in the Department of Energy and a lot of very strong specialist consultants that they brought in looked at what we were doing exhaustively and decided that they would fund what we had already accomplished plus onward expansion. So next spring, we'll have that 120 to 150 million gallons per year of SAF capability that Tim mentioned. And a couple of years later, we'll have the capability to have that number be 300 million gallons a year. Now, if that continues to make sense, if the market continues to go in that direction, if the demand is there, if public policy continues to want to support that at the federal level, then that's all on a set of rails. If some of those things change, we expect to be nimble, we expect to be quick, and we expect to step out of the way of dangerous developments and remain aligned with our partners at the DOE, our partners at Warburg, and frankly, our offtake partners.
So getting to 300 with max SAF, and you're at 30 now, right? So you're looking at potentially a 10x expansion in terms of your productive capacity.
Yeah, that's correct, Peter. The easiest way to think about that, though, 30 is kind of a nominal benchmark, and we've talked about that a lot. We've had the hardware a bit above that. So we've pushed up to test the limits so that we could design our constraint removal. So all we're doing in the spring is addressing a couple of low-hanging fruit type constraint removal opportunities. That will let us be in the 120 to 150 million gallons, but that's flexibility. That's trading SAF and renewable diesel at our current total size. So now we've got more flexibility to follow market dynamics, which is going to be very helpful, we think. The 300 million gallons is a physical throughput, which we're going to double. That's a larger undertaking, but the key to that, and this goes to two levels, I think, of underwriting, but the key to that is we're not showing up with a mega project. We're working up a staircase of discrete, tactical, bite-sized things. There's probably no one particular effort in this program that's larger than about $50 or $100 million discretely. We've got half a dozen of these little things going on. And as we run up that staircase, we've got the ability to tune and redirect if appropriate.
Okay, got it. That's great. So one thing I'd like to ask all of our guests on these podcasts is what do you think that analysts, investors kind of misunderstand or get wrong most about either your company's strategy or the overall industry outlook? Is there anything you'd like to kind of highlight?
It's a great question, and I think, yeah, let me respond to a couple of facets of that. First of all, when this whole industry bubbled up in North America out of effectively nowhere, that was because COVID exposed some marginal refineries. They shut down, and then a number of them converted to renewable diesel. I think 4 years ago, that was misunderstood as a growth rate that was economically motivated. It was not. It was a one-off step change from a bunch of engineers that said, well, if you're not using the refinery for anything else, we've got an idea. Let's do this. It's not a growth rate, and we don't see a lot more capacity coming along. The policy support is not enough to justify new capital. It's enough to justify in-place capital continuing to run. So I think the 4 year ago vision missed that this was not a trend, it was a one-off repurposing. It also went to one of my pet discussion points is, oh, there's not enough feedstock. Well, we were contrarian. We didn't believe that was true 4 years ago. Today, it's probably conventional wisdom that there is enough feedstock. But the next conversation is going to become specialized. Well, we want the feedstock to have particular characteristics. We only want it to be a true waste. We don't want it to have an alternate as food or that sort of thing. And I would simply caution the people that take those concepts and project them forward. That is suboptimal thinking because all of these feedstocks are interchangeable. They are all going to have the same value in use, adjusted for their carbon emission characteristics. They have already all synced up. And it is just like petroleum refining. We can all run all of the crude oils in the world. They don't price the same, but that's because they cost different amounts to run through the hardware and they yield different yield slates. All of the feedstocks are going to continue to run through all of the hardware. If you subcategorize that, and I use the IRA legislation as an example, somebody else is going to say, that's not what we wanted. And the feedstock that, administration rule number 2 barred is going to show up in country B as eligible. So, you can't say there's not enough feedstock, but you can say we're going to heavily rearrange the feedstock and we're going to have preference and there's going to be underlying policy reasons for that preference. That's fine. We're simply here to follow the rules. You make the rules, we follow them, and we will optimize against that. We can run any feedstock from anywhere in the world. We've got the hardware capability to do that. On one level, I don't care. But on another level, I would say, why are you messing with feedstocks? Because the more you balkanize that, the more you tinker, the more you put your thumb on a scale, the higher the cost of the final product because you just embedded inefficiencies in the middle of a global value chain. Why would you want to do that? So what you want, now I'll make a bold recommendation for regulators. policy level recommendation. Let's have the feedstocks remain an open and a free commerce activity, particularly in North America. I think the federal government agreed with that when the Senate passed the PTC legislation the way it did a couple months ago. So that's fine. But if you want to favor domestic agriculture, we're all for it. Here's the largest ag investment in Montana history. We want to favor domestic agriculture. We want to favor domestic energy security. We want to favor value add manufacturing in this country. So what do you say? We keep the taxpayers' money onshore, increase the utilization of the installed renewable diesel and biodiesel capacity by finding a way to take an imported renewable fuel and cause it to pay more to access our markets. That could be a tariff, that could be a 50% RIN if you were an imported renewable fuel. That could be a lot of things. But if you favor the domestic ag space, you should favor taxpayer money flowing to a stronger bio-based diesel utilization.
If only politicians were as pragmatic as you, Bruce.
Well, I think they are. You know, we have to read a lot of tea leaves to get a sense of why the various policy initiatives are, you know, maybe at a root level consistent, and you know they're not fully coherent. So those are two words. I think they're collectively supportive and directionally consistent, but they're not coherent. So the EPA says if you're a foreign source feedstock or product, you know, renewable product, we're going to tag you on your way into the country. The producer's tax credit didn't say the same thing. And you'd like to think that the federal structure would harmonize so that, you know, we didn't have weird discontinuities inside of rulemaking. So I think that'll happen. I think it'll unfold that way. And I'm hoping and believe on some level today that the policy making officers understand that the last administration assigned the bio-based diesel industry to run at 50% of installed capacity. I mean, that's a face palm. Are you kidding me? And you're letting the taxpayer money leave the country while you take a domestic biodiesel industry and force it offline. The current administration is fixing that. We're very pleased with the direction that they're going. We think that they were on a certain level a bit timid. It's easy to get tangled in the weeds of all of the numbers. Let's not. Let's make this simple. Please schedule the existing installed capacity that's available for use right now. Please schedule it at 90% utilization. We will make that much biodiesel and renewable diesel, and we will displace that much foreign import, whether it's a foreign renewable import or a foreign crude oil import. Either way, that is adding to the domestic manufacturing value add. It is adding to markets for the ag sector, which is going to be in a lot of trouble this fall. You know, you can cover that story separately, but why wouldn't you make a domestic market for those crops? Why wouldn't you add value here? Why wouldn't you displace imports? Why wouldn't you keep the taxpayers' money onshore? This is a screaming no-brainer for the policy guys. And if we don't get tangled in the weeds and we simply say all roads lead to 90% utilization, we're going to have a very, very powerful and very beneficial outcome.
So we've covered a lot here today, Bruce. I just want to ask you, sort of filtering through all these topics for investors, what would you say, you know, over the next 12 to 18 months that investors should be focused on in terms of the key milestones?
Yeah, so on the industry level, SAF is going to continue to grow. It's going to be pulled by a volume mandate, not in North America, but overseas. But these are fungible products and they don't cost a lot to ship on a foreign flag. So we've got a summary of what those global regulations are up on our website. And we've stroked a line across that at the existing available capacity, and it says the shortage is here and the shortage is growing. So something's going to have to give, and investors can decide if they want to invest into a domestic industry in the in the North American voluntary market, or if they want to go to a investment in a mandate industry, that would point to the EU. I'm simply saying that's a false choice because they're fungible and they're going to be the same, and the SAF price is going to be the global SAF price. So as soon as you cross that bridge, look, we're the low-cost producer. That's why we're collecting a $1 to $2 a gallon premium above renewable diesel. That's why we're posting in the green. We're positive cash flow. We've argued we're low cost on the supply stack, and we've published our analytics. That's in our investor communication. So once you get to, I want to make an investment in this market, you should probably want to buy the low cost producer who's going to be resilient against all of the dynamics we've talked about.
Okay, that's great. So thank you so much, Bruce, for taking the time to join us today and sharing your insights. Again, we've covered a lot today. This is a very exciting story, and we'll look forward to continuing to follow that here. So, but before I pass the podcast back over to Tim, just want to give you a chance to provide any concluding remarks.
The idea that the energy transition is shut it down and start over again is a failure to appreciate that energy is always transitioning. So I think what's being discovered now is there is national interest to be had in domestic energy security. It's an old concept that's come back around again. And renewables are a way forward. It's cleaner. It's probably better for the environment. It requires a recognition that this is at the root of it, ag support. And at that point, it's bipartisan, and it's going to continue to proceed. So, we're pretty excited about the alignment of policy, alignment of national interest, alignment of economics, and our position on the supply stack. That's a lot to take on, and don't join if you don't like roller coaster rides.
Okay, that's great. Thank you. Tim, over to you.
Thanks, Peter. I always had an appreciation, as a former chemicals analyst on Wall Street, I've always had an appreciation for SAF, but I didn't fully appreciate what a smoking hot space this is until I started looking at just the sheer number of major conferences being held around the US and reading the airlines talking about this space. So I think you're in a really, really great place. So thanks for joining us today, Bruce Fleming, CEO of Montana Renewables, an unrestricted subsidiary of Calumet NASDAQ, ticker symbol CLMT. NASDAQ ticker symbol CLMT. And thanks to my equity research colleague, Peter Gastreich, for also joining us today. Finally, a special thanks to the producer and editor of the podcast, Krista Fitzpatrick. Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to stay up to speed on the company's small cap written research reports, podcasts, fireside chats, and conference schedules. We will see you next time for another edition of the WTR Small Cap Spotlight podcast.